Apologies for the delay. Welcome to Tata Motors Q1 FY23 earnings conference call. I'm joined today by Mr. Thierry Bolloré, CEO Jaguar Land Rover, Mr. P.B. Balaji, Group CFO Tata Motors, Mr. Girish Bhatt, Executive Director Tata Motors, Mr. Shailesh Chandra, MD Tata Motors Passenger Vehicles Limited and Tata Passenger Electric Mobility Limited, Mr. Adrian Mardell, CFO Jaguar Land Rover, and my colleagues from the Investor Relations team. Today we plan to walk you through the earnings presentation followed by Q&A. As a reminder, all participant lines will be in listen-only mode and we will be taking questions via the Teams platform, which is already open for you to submit your questions. You are requested to mention your name and the name of the organization you represent while submitting the questions. I now hand over to Balaji to begin the presentation.
Thank you. Firstly, thanks everybody for taking the time to join the session. And as is customary, we'll quickly cover the presentation slides, assuming that you have gone through it or had a first look glance at it, and obviously spend as much time as possible on the Q&A. Having the safe harbor statement, you're well aware of, nothing new there. Just again, a reminder to everybody that the way the numbers are being presented is consolidated view downwards into Tata branded commercial vehicles anywhere in the world, Tata branded passenger vehicles anywhere in the world, Jaguar Land Rover, vehicle financing. That's how the verticals are done. No change in that, just a reminder. Next one. Again, it's been another intense period for us, both in TML and in JLR. And for us, that clear call out I would want to make is in terms of the incorporation of the Smart Mobility Solutions subsidiary for managing the GCC business of the Government of India and the State Transport Undertaking. And of course, the EV portfolio continues to expand with the launch of Nexon EV Prime. And JLR for the Defender 130 launch, we'll talk about later, it's come through this quarter. And the focus continues to deliver results for us. And the order bank grows to a new record of 200,000 units. Next slide, please. On the financials, let me start by putting it in context that it has been a disappointing quarter for us, and we are well aware of these numbers did not match our own expectations when we started the quarter. Yes, there is a fair amount of challenges on semiconductors and COVID-related lockdown that we had to contend with. But at the same time, the one that really caused us grief was the ramp up, the slower than expected ramp up that we had in Range Rover and Range Rover Sport. And I'm sure Thierry and Adrian are going to talk about it in the coming plan. But as we end the quarter and we enter into Q2, we believe we are in a strong wicket and therefore are quite confident of how the current quarter is going to land up, that is Q2. But that's for the future. But let's quickly delve into Q1. Growth of 48% in wholesale and about 8% revenue growth, and the PBT before exceptional item of about 100,500 crores in JLR on pension-related matters, which Adrian will talk about, is a 5,000 crore loss. EBITDA deteriorated by about 90 basis year on year, and EBIT percentages of about 60 basis improvement compared to last year, same time, is something that could have been better. And FCF on an outflow basis of about 9,800 crores. Most of it is working capital, so not particularly worried about it. Next slide. Obviously, the numbers also got impacted by the revaluations of FX and commodity hedges in the highly volatile FX and commodity markets. Next slide. Source of growth, if you look at it, we grew about 8% in revenue terms, volume and price contributing roughly 50-50. And translation took away a lot of it. This is basically pound sterling depreciating a lot vis-a-vis the Indian rupee, and therefore that's what you see as a 4.3% in the translation. On the profitability improvement, most of the cylinders fired within CV, PV, and the others, and of course JLR took down their bit profitability because of their challenges that they had, which I'm sure will turn around in this quarter. Net automotive debt went up from 48,700 to about 60,700 crores. Almost entirely explained by working capital and about 2,000 crores of underlying external debt that is there to 34,800. But that should reverse once the profitability improves. With this, let me now hand it over to Adrian to take you in JLR in a bit of detail. Adrian?
Yeah, many thanks, Balaji. Next slide, please. Okay, so this is our six quadrant. As Balaji said, disappointing quarter for us in Q1. Retails were balanced the same So as you'll see in the presentation, we have no concerns about demand and retail levels at all. Revenue was down, wholesale volumes were down 7%, and that's reflected in the revenue, but particularly because of the model changeover, nameplates Range Rover and Range Rover Sport in the quarter. We had a particularly weak mix within that revenue base. And that really is the story for the losses that you see there, the 500 million. The EBITDA 6% and the EBIT minus 4% in the quarter. Free cash flow was minus 769. That's not a number we're proud of, although it is the best quarter one result for 5 years, incredibly. But we can do much, much better with that in Q2 and going forwards. We're certain of that. Next slide. Okay, so these are the key performance highlights. I've mentioned some of them. Order banks, Balaji mentioned, up to 200,000 units. We will take you through that. There is a pensions benefit for the re-establishment of our future pension liabilities at an inflation level of CPI rather than RPI. That's excluded from that loss before tax because it's non-EBIT related. A refocus program continues to go well. I will take you through that. And the liquidity continues to be strong, 3.7 billion cash on hand and a 1.5 billion revolving credit facility from July 2022. So total liquidity, 5 billion plus. Next slide, please. Okay, so this is our retails and our wholesales in quarter one by brand. We've broken this out by we used to refer this to nameplate families. We're now referencing this as individual brands. Retails at the top there, you see a flat, and they're pretty much flat across all of the brands. Obviously, that's retails are being fed from dealer inventory. I do have an inventory slide later, and there's some things on there that hopefully you'll see as this starting to turn around for us. Wholesales, this really lands on the point about our Range Rover and our Range Rover Sport. You can see there in the Range Rover brand, wholesales are the lowest quarter over quarter and versus last year. That's where we've fallen because we haven't been able to build up the production in that new facility. I'll talk to that later, as well as fast as we would have wished. And that's really the story behind the total wholesale reduction in the quarter. Defender was stronger than previous quarters and last year, as that plant in Nitra is getting closer to a level of production than any other plant at the moment. Next slide, please. And this is the same data, but now broken down by regional sales, retails again at the top. And what you see here, which, knowing our profile of what we sell where is corroboratory to the last page, we've done weakest in our regions that are most reliant on our Range Rover and our Range Rover Sport because of our inability to ramp those products up at the speed we would have wished. So North America is down significantly, heavy Range Rover Sport region. So is China down, heavy Range Rover Sport region, and also snippets of overseas. Rover Sport, the improvements we've made over the last 6 weeks, where we ended up in July in a much better place in April. With what we see in front of us, we're now starting to see the capability to deliver 90,000 units to our dealers and importers in Q2. So a significant jump from that Q1. Next slide, please. And the orders have kept growing. In fact, they've grown in this quarter larger than any other quarter, marginally larger than the quarter when we announced and showed the Range Rover in October last year. We've now got 200,000 customer orders. That excludes the dealer orders, of course. And you can see there our 3 latest and greatest product offerings, Range Rover, the Range Rover Sport at the bottom there, and the Defender, making up almost 65% of that volume. They are our most valuable brands and most valuable nameplates as well. So we have a super healthy order bank, a super healthy future revenue stream, and we're starting to break through the production issues. And there's starting to be light at the end of a very long tunnel on supply and semiconductors as well. So a lot of that is not reflected in Q1. That's why we're really disappointed, and as you can probably hear from my voice, a tad frustrated about Q1 as well. But we are starting to see those core ingredients move in our favour into Q2. Next slide, please. And we've also revealed a new member of our Defender brand family, the Defender 130, the extension of the vehicle at the rear, beyond the rear wheels. This vehicle will safely and comfortably occupy 8 adults. We expect it to be very, very popular in our US and some Middle Eastern markets as well. And if you did notice, even though the production at Nitra is closest to a normal level than any other plant, our demand and orders for Defender increased by 5,000-6,000 units in the quarter. A lot of that was for this vehicle. So it's had an incredibly fast start and appeal, even though it was only revealed a month before the end of the quarter. Next slide, please. Okay, refocus. Look, we did 1.5 billion last year. Even though it was a very thin transactional value quarter for us, we still did 250 million in Q1. That was broken down in 3 constituents. You've seen most of that data already earlier in the presentation. The net pricing value was 120 million. That's a big constituent of it. We are starting to see labour and efficiency benefits within our agile transformation, particularly within the engineering fraternity. Obviously, we're doing that mostly to ensure that we speed up the quality maturation and the delivery of our products. But of course, the unspoken within there is the cost of delivering them will be lower, also spending less time and less people hours on it. And then the investment number, which was low for the quarter and therefore did contribute in this quarter. But I do expect that to be much, much less in later quarters, and I expect the other constituents to be greater. Next slide, please. So inflation, we'll be talking about inflation, I'm certain, for the next few quarters. Now, we introduced this slide earlier this year. It's the same slide on the left. 12.5 billion cost base, variable cost base. 4 significant elements within there which are suspect to high inflation levels: labour, commodity costs, semiconductor prices, and energy, of course. And the balance between the pressures have shifted a little bit. We went into the quarter with aluminium at $3,500 a tonne. We've come out the quarter with $2,400. Palladium came down as well, $300. So it shifted a little bit, temporarily perhaps, from commodities. But of course, we're getting some utility, energy cost increases, semiconductor cost increases, and labour cost increases. So the absolute number for the quarter versus last year was £160 million greater. It's a little bit less than I was expecting actually in the quarter. I was expecting up to 200 million. And some of these headwinds are stronger and some of them are starting to alleviate. But I think it's reasonable to assume we will have quarter over quarter data of this type of scale and size as we go through at least the next 2 quarters. Not certain about where we end up in Q4 yet. And our refocus program, we're very, very confident will more than offset, and almost did, well, in fact, it did offset, even though not fully in EBIT, the on-cost and inflation as we go through FY23. So I'll repeat 2 or 3 things here. One is we're very confident about the overall scale of the program and what we will do this year. We're confident that it will offset in total the absolute amount of inflation. And as we go into the second half of the year, we expect an EBIT offset also, as most of the inflationary pressures we're seeing is then overtaken by the other things that we are doing, including the pricing actions, which will come through later in the year. Next slide, please. This is an important slide, although it doesn't look it. Right. So this is the health of our end-to-end pipeline from build to shipping those vehicles. And if I take you back to January 21, we've talked this 2 or 3 times before, but I wanted to talk specifically today. If I take you back to January 21, that's as close to a normal, healthy pre-semiconductor pipeline that we have. And it increases and falls down because of the aberration called March in the UK, where we build units and then we sell them. So if you draw a line versus the first 3 months, you'll see pretty much 60,000 units in the dealer pipeline and 40,000 units in our pipeline. 100,000 total units would have been a pre-semiconductor normal environment. And from there, our order bank is about twice of our dealer inventory. That's what we would have expected before semiconductors. WIP's about 4,000 units. That's what that blue line lived. But WIP is a subset of the grey line called JLR inventory. We own the WIP, we own the JLR inventory. That's on our balance sheet. That's a part of the £3 billion that you would have seen if you look at the balance sheet. It really, really fell as we went through our Q2. You will remember the Q2. They both fell towards the 30,000 level from an inventory, a dealer and an inventory at JLR perspective. But our WIP also fell to about 2,000 units, right? So we were building cars, but very, very few. We've gradually grown both of these over the course of the last 3 quarters, through to June. And there's been a significant uptick, as you can see there, in June. So what that means, we are releasing more cars into the dealer network, and we are releasing more cars onto transporters, onto trains, and onto ships. And they will turn into retails and wholesales at some point. And we do believe a part of that uplift is going to happen in Q2. Now, we did end up with 10,000 cars in work in progress at the end of June. 5,000 of those were Range Rovers and Range Rover Sport. And I'm simply giving you more corroborative evidence to the real breakthrough here is in that facility at Solihull, Range Rover Sport. That should have been 1,000, not 5,000. And we're starting to work that number down, including during our shutdown period this week and next week. And we have high confidence those units will also be released onto those transporters, ships and trains as we go through August and into September. So we are a long, long way away from being normal here, but this is evidence that it's starting to shift back towards a more normal
rupee depreciation because the hedges on the exports did lose money, and this in turn get compensated by the dividend income coming in from Tata coming. So overall, that pieces the numbers balance each other out. But the other call out I would definitely say is look at the line between realizations versus variable costs. This number, if you recollect, used to be at 40 bips. So most of the pricing actions have gone through, realizations to offset the commodity costs have gone through, and therefore we should start seeing this starting to improve here on. Next slide. Girish.
Yeah, thanks, Balaji. So some of the highlights for the quarter, I think the industry continued good recovery and doubled the volume over the Q1 of last year. Of course, the last Q1 was marked by the pandemic second wave, but nevertheless, I think good growth shown in Q1. The EBIT margin improved by 690 bips, driven by the revenue growth, as also the pricing and cost actions that we've taken, and has also grown 240 basis points over FY22 full year. We continue to see a very good growth in our spares and service penetration, thereby improving the non-vehicle business revenue by 75% over Q1 of last year. And this is, of course, a good profitable stream for us. On new products, we continue to launch. 15 new products were launched along with 25 variants. And as all of you know, we also launched the Ace electric vehicle in the quarter gone by. Some of the bright spots, we've seen that the trucker sentiment index, which we track every quarter, is now almost at a 2-year high in MNSCVs and intermediate and light commercial vehicles. Of course, this survey was done just before the first interest rate hike was announced. So we are keeping a track of this. There has been some softening of the sentiment after that, but I think overall it remains very, very positive. On the commodity side, did show some hardening up during the beginning of the quarter, but towards the end, I think we are seeing signs of softening after a good upward run since second half of last year. Coming to the passenger segment, finally we are seeing a return of demand. So with the staff movement, that is employee transportation to offices and factories back in place, as also tours and travel, and specifically opening of schools has led to good demand. And the volumes grew by 60% over Q4 of last year, which is just the quarter gone by, and almost four times that of what we had seen in the first quarter of last year. So very good demand coming back, although this is still lower than the highs which were achieved in FY19. Balaji spoke about the retail push that we have initiated, and happy to tell you that we had the highest retails in small commercial vehicle and pickup in Q1 of any year for almost last 10 years. Going ahead, some of the focus areas, I think our international markets demand has been impacted, especially in SAARC as well as Sub-Saharan Africa, essentially due to steep depreciation in the local currency, along with fuel price hike, and of course Sri Lanka. All of us know about the political turmoil. In these circumstances, we are looking at alternate markets and products to see how we can get back to the required level of volumes for international business. I spoke about the retail acceleration and a lot of demand pull to ensure that we actually have sustainable gains going ahead, sustainable share gains. So there's a lot of push on the digital lead generation. I'm happy to tell you that 20% of our volumes are now coming from leads coming from digital in small commercial vehicle and pickup. With the interest rates increasing, I think we have continued our engagement with the key financials and trying to find out ways and means to see how we can support the customers in this environment. We started the margin improvement journey towards the second half of last year. We continue to do that, and is being driven by both pricing actions as well as the cost savings, and the fundamental margin has improved quarter on quarter from Q4 to Q1. Next slide. Update on the new businesses on electric mobility. Happy to inform you that additionally 100 electric buses were delivered in Q1. So now we have cumulative 715 electric buses running on Indian roads and cumulative coverage of more than 40 million kilometers. So that's a good experience that we have and over multiple cities in the country. We are also working on the fuel cell electric bus, as we've been mentioning, and the program is on track. And in fact, we had first milestone review with IOCL, with whom we are working jointly. And this milestone has been completed successfully, and both the partners were quite happy with the progress. We did foray into the last mile e-mobility on cargo side with the launch of ACE. And we have memorandum of understanding for now 39,000 units. We already started customer trials, and towards the end of this quarter, we will also start delivery of products. Going ahead, we also incorporated the TML Smart City Mobility Solutions Limited as a subsidiary and operationalized 53 buses in Delhi Transport Corporation. And as a part of the Smart City Mobility Solutions, which is the gross cost contract model or own and operate model, we are now managing 450 buses, more than 450 buses, and delivering more than 96% uptime. And all of you know, we were declared L1 for the largest global tender of more than 5,000 e-buses. And now we have received LOA, that is letter of allocation from Delhi Transport Corporation amongst these 5,000 buses for around 1,500. We are engaging with the rest of the cities and their transport undertakings, get LOAs for their share as well. As an outcome, the revenue which this business has generated in Q1 is around 145 crores, and we are on track in terms of the revenue trajectory. On the digital businesses, Fleet Edge, we are focusing on increasing adoption and active usage. So we have more than 235,000 vehicles now, amounting to around 100,000 customers who are already onboarded. We are now initiating the minimum viable product 2 of our Fleet Edge is already being piloted with few customers. It will be launched in next month. This will enhance the user experience further. So this is based on the expectations that we have captured from the customers. And finally, our digital storefront for spare parts, called as e-Dukaan, is doing pretty well, continues to grow, and has grown 26% in revenue over Q4 of last year. So that's in summary of about the new businesses. Back to you, Balaji.
Thank you, Girish. Just moving on to the passenger vehicle business. Call out on this slide is fundamentally around the powertrain mix. What's the CNG numbers now increasing to 11%? EVs continue to grow strong at 7%. Next slide. And market share of over 14.3%, and the EV market share continues strong at 88%. Next slide. And from an overall financials perspective, we continue to do well on the improvements in profitability that we are putting through. So the business is now on a
being discussed, and the change will be going forward. As far as industry is concerned, we clearly see that for this financial year, industry will grow to nearly 3.5 million. EV demand is going to continue to remain strong with continued positive word of mouth of nearly 40,000 EV customers that we have today. As far as Tata Motors is concerned, at the start of the Q2, we have a very robust booking pipeline and low channel inventory, which bodes well for quarter 2. Demand for SUVs remains strong. We have a very strong booking pipeline here also. There has been a good traction of CNG, which continues. We expect the vehicle supply to improve with better semiconductor availability in quarter 2. Rural demand is expected to be strong on the back of good monsoon. And Nexon EV Max, which we launched in May, has seen tremendous response and has augmented the EV demand. And supplies are expected to increase in quarter 3. Going forward, the challenges, the way we see is that the high inflation and interest rate may start impacting the auto demand. While there's no stress as far as Q2 is concerned, until the festive season, we don't see a concern, although we also don't see a sign as far as the dampening of demand is concerned. But given how the retail industry is getting impacted because of these factors, we have to be a bit watchful. And post the festive season, it will be litmus test of how the industry demand sustains. As far as Tata Motors is concerned, we will remain focused on demand generation activities with now a segment level and micro market level focus. We continue to enhance the supplies further with as the semiconductor availability also improves, and we'll fast track the cost reduction effort to back to you, Balaji.
Thank you, Shailesh. Moving quickly on to the cash flow slides are already there. Let's skip that. Go straight into the Tata Motors Finance. Go to the next one. Next one. Yeah. So here, callouts here, collection efficiency started to improve now at 98% for June, and therefore GNPA will keep improving with every passing quarter, and fully compliant with all the new PCA norms that RBI has put in place, and both capital adequacy and liquidity remains comfortable. And the aspiration is to take that ROE from 5.1% all the way up to double digit in the foreseeable future. Next slide. So coming on to the outlook, key callouts, demand remains strong, and we expect it to remain strong despite inflation and geopolitical situation. Obviously, we need to watch the Indian CV situation carefully, but right now we don't see any cause for concern at this point in time. Chip supply is expected to improve further from Q2, and therefore cooling, and added with the cooling commodity prices, that should also help in underlying margins. And therefore, we do aim to deliver the strong improvement in EBIT and free cash flows from Q2 onwards. And one of the key things in this is what Adrian talked extensively about is JLR delivering on 90K, and on this side, continuing to improve market shares while restoring double-digit EBITDA margin will be the key imperative of PV, for CV, and of course PV keep the show going and accelerate as much as possible. So that's in a broad nutshell what we are working on. Happy to take any questions that you may have. I already see we have about 13 odd questions that have landed up already. Let me start. I think Girish, the first one is coming your way. This is from Sonal Gupta, L&T Mutual Fund. M&HCV market share is now down to 54.6% in Q1. Is there a level at which you expect this to stabilize? And what are the risks that the commodity benefits are competed away in that CV business? Commodity benefits are given away in the CV business.
Okay. So, first of all, on the market share front, so I think over the past 4 years, we have been consistently growing market share in M&HCV. We've seen some softening happening in Q1, but we are determined to get this back. And on the back of various actions that we have, both on the demand generation front as well as launch of new products, I think we should be getting it back. So certainly not satisfied at this level. As far as the commodities are concerned, sorry, Balaji.
Commodity margins are likely to be given away and due to intense competition.
So I think we have a comprehensive margin improvement plan running, which is working on both the planks. That is, how do we improve the realization basis, delivering more value to the customer. And the second thing is, how do we keep on shaving off cost? And one of the cost benefits is, the commodity reductions, which are likely to happen. So we see how it comes.
And also, Sonal, just to add to that point, if you recollect the outlook, we're specifically calling out you reach double-digit EBITDA earlier, so that's clearly an imperative for this business. Okay, next slide. Next question from Jinesh Gandhi on to JLR. Adrian, I think this is coming your way. How should we think about mix for JLR, considering ramp up in Range Rover Sport Defender, but also chip supply is expected to improve? Should mix further deteriorate over first quarter levels? And the second question, do you expect strong and consistent increase in wholesales from second quarter from the 90K levels that we've signaled? And lastly, in which line item does an effect revaluation and unrealized commodity hedges get reflected? 3 questions.
Okay, thanks, Balaji. So, the mix was really weak in quarter one. Range Rover mix was about 8% of that 70,000 units. Our order bank is telling us that between Range Rover and Range Rover Sport, it's 40% of the order bank there. So there's a significant improvement of mix that will happen once we start to overcome those issues we've referenced significantly in the quarterly results so far. So I absolutely anticipate mix not only to improve in quarter two, but to continue improving through the balance of the year as those production challenges continue to reduce. Do I expect strong and consistent increase in wholesales from Q2? Look, I expect each quarter to be better than the quarter before. That's no different actually to what I've been saying for the last 2 to 3 quarters. I did expect that in this quarter also, actually. So if I had to pull a number on the data last in March, that number would have been 70,000 high rather than 70,000 mid, and the difference would have all been Range Rovers, and that would have actually started to shape the quarter much closer to the level of EBIT stroke cash loss I was inferring on May the 13th. So I do expect each quarter to be better than the last. I can see the data for the first 3 weeks. We're now building consistently above 7,000 units a week, and we're building consistently week on week on week. That will increase to the 8,000 units plus, which we will need in this quarter when we start building Range Rover Sports. We haven't built Range Rover Sports for 6 to 7 weeks apart from a few units just in proof and trial. That will begin to happen post shutdown from the 8th of August. So we're pretty confident actually with what we see in front of us that the build will grow from 7 to 8,000 units a week. We have 11 production weeks in the quarter. That gets you close to the 90,000 units. And we have 10,000 units in WIP, which will reduce. And therefore, that's why we're saying we think the wholesale number will be 90,000 units. And which line item does FX revaluation? Well, it appears down the whole stub. So it's significant on revenue, of course, as we bring all of the overseas revenues into sterling. It's significant on cost, of course, because so much of our cost base is sourced in overseas currencies, around 55%, a lot in euros. But it's line by line. So if you take marketing costs, then within the marketing costs, which are obviously in the other expenses, we add up all of the foreign currency pieces. And then we have a big line item in there, which really covers, our exchange losses. So it's down the whole stub.
We are further working on the food asset.
Thanks, Shailesh. Girish, your way. Are you seeing sustenance of demand from small fleet operators?
Yeah, so, few things I would like to say. First is the sentiment index that we measure is at a high. and therefore that is an indication of the interest from both large as well as small fleet operators. Also, if you see the intermediate and light commercial vehicles as well as small commercial vehicles, generally the small or retail customers, single vehicle owners are the buyers for these vehicles. And these segments have grown more than that of M&HCV. So actually the small fleet owners, single vehicle owners are still in the market and not likely to see softening immediately.
The point on inflation, which I'll pick up, Dinesh, we expect commodity savings to come in second quarter. We do see commodities starting to pull off, and you should start seeing this coming from second half as the current hedges wear off, as well as some of the contracts we are putting in place start coming through. So let's see how it plays out. Next question is from Ronak Sagar, Systematics. Any specific headwinds on CV EBITDA margin as Q1 FY23 production was largely similar to Q4, coupled with softening RF?
Yeah, so I think 2 points I would like to make. One is, of course, the scale impact. So the revenue has actually gone down by 15% from Q4 to Q1. So that is one of the reasons. Second is that the M&HCV volumes have come down by more than 20% from Q4 to Q1. So this certainly has an impact on the margins. But what I would like to say is, on the back of the pricing and the cost reduction actions that we've taken, the fundamental contribution or underlying contribution margin has actually improved over Q4 of the last year.
Thanks, Shailesh. Thanks, Girish. Next question is to me, actually. On India e-bus order wins, can you please take us through how the GCC order win will be accounted in the financials? Okay, there are two things here. One is the Tata Motors standalone, and then there's the subsidiary Tata Motors Smart Mobility Solutions Limited. So there will first be a sale happening from Tata Motors to Tata Motors standalone to the Smart Mobility Solution. This will be considered as a sale in the standalone books, but in the consolidated books, this will cancel each other out, so the revenue will not be recognized. Number one. Number two, this asset continues to remain in the Smart Mobility Solutions books, and the collections will happen over a period of time as this bus starts running, and therefore there will be a revenue recognition happening on in terms of rupees per kilometer, in terms of the number of kilometers that it traverses, and that will be the Smart Mobility Solutions books, against which the running cost, operating cost, etc. will be set off against. Over a period of time, once this particular, so obviously the next question that comes is, you'll keep building assets in your books. The answer is yes. And over a period of time, once the collection history has been established, then you'll be able to take this asset off your books. You'll be able to sell down these assets. There are multiple options out there. And there are also other conversations that are happening with the government to find a way to actually ring-fence this at the inception itself. And those you should start seeing some results of those deliberations in the coming year, and definitely before the next tender that comes out of this size. But there's a lot of possibilities to how to actually lighten the balance sheet and reduce the collection risk and the solvency risk of the STUs. Okay, next question from Prateek Podar, Nippon India AMC. JLR has called out a production of close to 90k units. Is it fair to say that the visibility of build rates as guided in Q2 is very high? Prateek, Adrian has covered this elaborately, therefore I wouldn't want to repeat this. If yes, can you highlight some of the reasons for the same, which is already done so? And on the India PV division, looks like the model cycle tailwind for us is over, although model refresh can be a lever. Is there a concern within the team that the market share loss might be a possibility going forward unless we start with a new model cycle? Correct?
Yeah, so I think you're well aware of the intensifying competitive landscape country, and sustaining our share. I think we have 2-3 points here to share. One, that as you rightly mentioned, that the cycle plan or the MCs and refreshes is a cycle that we'll see in the next 2 to 3 years starting next year, and that should not only help us sustain but slightly grow our market share. Also, right now, the share level at which we are, there's further headroom because we are still, our supplies are less than the demand. The second major lever for us would be the powertrains. We have a unique position. We have a unique position where we have all the 4 powertrains: petrol, diesel, CNG, as well as electric. And therefore, we are at the sweet spot of the growth that we are going to see the next few years as far as CNG and electric is concerned. So that should give us, with the current models and with the expansion that we are going to see in the EV and CNG space as far as electrification and bringing more CNG models, we will witness a growth in this segment because of our unique position of having multi-powertrain option. And third is, of course, we have to add EV weights. There are certain gaps in our portfolio which we are going to fill in the coming years. One of them we have already shown to you, which is the concept curve, which we had revealed in April, which is going to come, while it is going to come with the first as an EV, but it is also going to come with the ICE powertrains also. And there will be additional nameplate which we'll announce at the right time. So mix of all these actions is going to ensure that we continue to grow our market position.
Thanks, Jayesh. Next question also your way. What's your backup plan in case hybrids become a success in the India PV market?
So as a company, see, we'll be closely watching how adoption of hybrid takes place. But see, one thing we are very clear that the long-term key drivers of the auto industry, as well as the governmental regulation and the issues that we have, as far as auto industry is concerned, this is the environmental issues. EV is the long-term play. And therefore, as a company, we are going to remain focused on EVs. Having said that, in the later part of this decade, as the emission norms are going to become more stringent, there will be a degree of electrification that you would require in the current ICE vehicles. And therefore, as an organization, we will keep ourselves prepared.
There's also a question on pricing. Can we launch EVs at prices similar to hybrids or a slight premium so that the value proposition of EVs can further improve vis-a-vis hybrid? Any thoughts?
I have no clue of the hybrid prices, frankly, because we are going to now see few hybrids, strong hybrids. I'm saying so far there have been few, mild hybrids or even lesser than mild hybrids. But we'll see how the pricing pans out. But as you are already seeing that we have launched our EVs which are 20 to 25% price, which is at premium to the current petrol and diesel model, automatic model. So it's already very competitive. I'm sure that this pricing would be competitive to a hybrid option that is going to come in the market. But let's see, the pricing when it gets announced and discussed.
Thank you. Next question is from Hitesh Goyal, CLSA. How much is your steel contracts pricing in Q1 higher than spot price? And if you take the steel cost at spot prices, should the margin be higher? Girish, you want to take that?
Yeah. So generally our steel contracts are for a period of 6 months, but due to the recent volatility, we shifted to 3 months. So we have been doing steel contracts on a quarterly basis. I can tell you that the spot prices are much more volatile and generally higher than the contracts that we have with the steel manufacturers.
Thank you. Next question, JLR, Adrian, coming your way. Is it possible, Adrian, to sum up what was the margin pressure in Q1 that was one-off in nature? You already talked about.
Sorry, Balaji, carry on.
Carry on, Adrian.
Okay, thank you. Yeah. So look, we pointed towards this. It was particular around the Range Rover and Range Rover Sport facility. We only built and wholesaled 6,000 Range Rovers in the quarter. That's a significant diluting impact in the margin. I won't give you the data, but your modelling should mostly point towards that data. So is it one-off in nature? Well, the binary impact of very low production on Range Rover and almost zero production on Range Rover Sport is absolutely binary impact to quarter one, which will progressively improve. So margins will increase as well. Carry on.
Yeah, the next question, I will skip the other one. The second one is on production, which you already covered extensively. Let's go to the one on hedges. When does the adverse impact of hedges start affecting operational numbers?
Yeah, well, it's already affecting the operational numbers, Balaji. I think if you went back to our walk, our EBIT walk and our profitability walk, I think it would have said that the operational exchange was 210 And the impact of those hedges was about 115 versus previous year. If I give you the rates, actually, the effective rate in Q1 was about 128. Our hedges is in place going forward just over 130. So on a quarter by quarter basis, we have got hedges around the 130 going forward, but it's not too dissimilar to the effective rate in Q1.
Okay. The next question is from Raghunandan, NK Global. For India business, can you please indicate commodity impact in Q1? I've already called out more of the commodity impact. Look at the thing between pricing versus realization. Sorry, realization versus variable cost. And you do see about a 30-40 bps still to be recovered, but we believe this will come off as we go forward. As far as the e-buses, the company has won large orders. What kind of equity infusion is planned in the company that will own the e-buses as supplies on a gross contract basis? Obviously, this will pan out over a period of time because the buses have to be delivered by till FY24 onward. So there is a fair amount of time in front of us, and we'll do it on a sequential basis. And we'll have to think through the equity and debt combination to get that right as well. So leave it with us at an appropriate time. We'll share with you. This will not complicate the calculations on getting net debt free. So you can press PC on that, but we'll still have to crack the fact that this is asset heavy and there's a lot of work underway to get that back. Girish, coming your way.
Yeah.
How do you see the MHCV industry outlook for this year?
Right. So I think
and the share of CNG vehicles.
Yes. So let me take the first one on MHCV. So I think this would be the fourth quarter when we've seen successive growth that has happened in MHCV. This is happening on the back of upfront infrastructure spending by the government, using freight rates, fleet utilization. So I think most of the things seem to be falling in place. As I mentioned in the presentation, I think we are keeping a watch on two monitorables. One is the fuel prices and second is the interest rates, and see what kind of impact it will have. But as of now, I think it appears that we will see double-digit growth in MHCVs for the entire year. As far as CNG vehicles are concerned, I think over the past 3 months, the competitiveness of CNG price has gone down significantly with respect to diesel, although the gap still remains. But as a result, we've seen that the CNG salience, which used to be around 40% in our ILCV portfolio, has already come down to around 25 to 27%. This is something we will also keep a watch on how the relative pricing between diesel and CNG plays out. I think as a company, we are ready for switching the portfolio either between diesel and CNG and ensure that we ride the one which is required in the market.
Thank you, Girish. Adrian, this is coming your way. A slightly different question on the production point. Has there been any change in bookings or the cancellation run rate at JLR as production rate of other players are rising ahead of us, or particularly this quarter when you had a challenge? And then the next question I think you have covered is on why the dealer inventory at JLR been rising for the last 2 quarters despite no real dip in order backlog, and any impact on the incremental demand due to the global economic growth concern.
Yeah, okay, Balaji, let me take the first one. Look, when you study those order banks, I think a couple of things are quite evident. The 3 nameplates, the newest product, including the Defender, of course. The orders for those 3 nameplates just keep growing. And there's several reasons for that. I mean, we're not building as many as we need to, of course. That's one piece of that. But there aren't many on the road either. And that means we anticipate that the orders for these 3 nameplates, particularly Range Rover Sport, will continue to grow. And the risk of cancellation on those nameplates is very, very low. I think there is a disparity when you look at the other nameplates we have. The orders for those other nameplates, if you notice that data, has stayed pretty flat over the last 9 to 12 months, around 70,000 units in total. We haven't built to the level we can build there. So I think it's pretty clear that once we can build all of the Range Rovers, Range Rover Sport, Defenders, Velars, Evoques, then, you know, once we go to a normal level of production, we will need to stimulate demand in some of these other nameplates, the lower transacting value nameplates, the SUV2 and SUV3 sectors, and also Jaguar sedans as well. But we are months away from that, we feel. Any cancellations we're getting are more in those lower value transacting nameplates, and there may be a link to question 3, which is a subset and a part of that, but that's unclear for us because it isn't that substantial yet. I think your question 2 about why is dealer inventory been growing? Just think of our global profile. As we build more Range Rovers and Range Rover Sports, and we have been, and I mentioned earlier about the slide, if you can visualize the slide about where do we actually sell those. We sell those mostly in, you know, markets which are far away, China, US of A, and of course we own that inventory until that inventory is passed through ports of entrance into those markets. So, you know, from dispatch from plants here in the UK right through to the point of receipt in Shanghai, receipt West, East and West US of A, that's on our inventory. So it's actually evidence that those cars are on the way. That's why it's growing, and it will continue to grow beyond this point when we get back to a normalized level, perhaps another 5,000 or 6,000 units. So it's actually a healthy sign, even though it may not look it when you read the cold data.
Thank you, Adrian. Next question is from Pramod Kumar, UBS. Adrian, this is coming your way again. Can you indicate the transaction price for the new Range Rover versus the old Range Rover, given the significant upgrade to the model?
No, I can't. Look, you know, I think this real data will show itself in 2 to 3 quarters time. You know, we're only built 6,000 cars. We've got 67,000 orders, 80-odd thousand across the two, almost 90,000 orders. It will be a great question when we get to Q4. But at this point in time, early orders, the richest value orders are the most complex and the most difficult to build. So they're some of the ones which are still sat in their work in progress. Any data I give you will be misleading, but it's going to be bigger, right? You know it's going to be bigger. Those transacting prices are going to be bigger, and they're going to be moving with close to 0 VME. So they're going to be a really rich, healthy part of our portfolio going forward.
Got it. We talked about the macro, so I would skip that. Question coming your way, Shailesh, order and Girish. Order backlog for India PV and CV segments.
Yeah, so
CV I wouldn't add. There's no order backlog there, but PV is a more relevant one.
yes, so we have a very strong order book, as I mentioned in my presentation also. And it ranges, you know, on an average, it's about 2.5 to 3 months of the average sales that we are doing right now. As far as the various models are concerned, for PV, ICE, it varies anywhere between 4 weeks to 3 months. For EVs, it is higher, especially for the Nexon EV Max. The average waiting period would be 7 months and upwards.
Okay, the next question is from Kapil Singh, Nomura. We talked about recession risk. Do we have order books demand? We've covered it. India PV, CV, commodity we've talked about. I think same with Gunjan. I think we've talked about all the points that she has raised in that PSL funding, model share, powertrain mix. I think we've talked about everything. Just go down. Question from Satyam Thakur, Credit Suisse. Given global luxury OEMs, including JLR, have seen GP per vehicle rise significantly over the last 6-8 quarters. Do you expect to use any benign commodity environment to incrementally boost unit profitability, or do you see industry using lower cost environment ahead to help support demand amidst a global growth concern? Thierry, I think this is probably right up your alley.
GP per vehicle, make sure I understand.
The gross profit per vehicle, given the contribution margins have gone up, with lower commodity costs coming in and more profits coming your way, do you expect to take it to the bottom line, or do you expect to stimulate demand?
Well, what we can see at the moment is that in our segments, the offer, the supply is not at the right level compared to the demand. That's the first element that people need to understand. So there is, we can see, as far as we are concerned, that the demand continues to increase, despite we are increasing the pricing, and just because there is a scarcity in the market, and because of the desirability of our products, are such that there is a kind of magic happening here. Demand increase and pricing increase at the same time, because it's clear that our profitability per car is also increasing, and we do more than compensating the inflationary impacts that we can see as well.
Thank you. Thanks, Thierry. I think we're probably arriving at the last question. This is from Preranjan, HDFC AMC. Shailesh, this is your question. Does it make sense for the company to think of an ICE variant of curve when the entire taxation structure gives us too much leeway to price the vehicle within 500 kilometers range at a similar price point?
Absolutely, it makes sense. That's the reason why we are making both ICE as well as EV. I think there's still going to be a significant difference between the EV as well as ICE, because here the attempt is to keep the premium that we have been keeping on the EV versus ICE, to increase the range, as we are able to take the benefit of taxation, as you rightly mentioned, at the same time take the benefit of any battery price reduction which might happen. Right now we are seeing a slight spike in short term. As it keeps on going down, by the time we launch, we expect that we'll be able to deliver better range as compared to what the current EVs are. So therefore, it makes sense. At different price points, you trigger demand for different customer segments. And of course, there will be customers who are very, touchy about certain powertrains. So I think we would like to give all the options to our customers.
Thank you, Shailesh. And with that, we come to the end of the Q&A session. I think first, once again, thanks for your time, all of you. Really appreciate it, and also the probing questions. As we started off, we do end this quarter on a disappointing note, but at the same time, a very clear plan of action and a pathway in front of us in terms of how to deliver the rest of the year in a very strong way, and therefore quite committed to the numbers and the targets that we put ourselves, and also deliver up to our own potential. Thank you, and speak to you in the next quarter.